So, sectorial balances. First question is probably what are sectorial balances and what can you get from them? How useful are they? So here are the four takeaways that hopefully we'll be able to go through tonight. The first one is that when you use sectorial balances, you can see very clearly that it's been possible for Scotland to comply with this Stability and Growth Pact, the financial rules, unless the government drastically reduces domestic savings and consumption by reducing government fiscal spending or increasing taxes on the private sector. And this was the one big takeaway from our paper. Next is that the sectoral balances show that deficits in Scotland are both needed and normal. Third, they highlight, and again, another big takeaway, that the Scottish economy is very leaky when it comes to our foreign sector. And then finally, we need a new approach. And you'll see that from the sectorial balances and the bit of analysis I'll give you, that if we want a resilient economy, we need to move away from the business as usual. And it's just not an option for us to run our economy like we have been run, or it has been run, if we want a progressive Scotland. So I hope you get those takeaways as we go through the presentation. So what are sectorial balances? So they're a macroeconomic framework that just looks at financial transactions. And when you just look at financial transactions, everyone knows that for everyone who has a debit, there's a credit or a liability or an asset. And when you take that kind of double entry approach to analysing the economy just through financial transactions, you start to see the whole economy as almost like a closed economy, and all financial transactions must sum to zero. Now, we break up, standard way to break up the economy when you're looking at sectorial balances is for the public sector, which is the government sector, the private sector, which is the domestic non-government sector, and the foreign sector. Okay, so that's the government, me and you, private sector, and the foreign sector balance. Now, that all has to sum to zero. So if the private sector is in surplus, someone else must be in deficit. And it all has to sum to zero. And that's the framework that gives you sectorial balances. And obviously, I'll go through it in a little bit more detail. Now, a better way to look at that, rather than these zeros and them summing up, is to say, well, if it all has to sum to zero, if the public sector balance, which is the government, is 3% of GDP as a figure, so the government runs a 3% surplus in GDP, then, and the foreign sector balance is zero, then the private sector balance must be, by definition, minus 3% GDP. That plus must come from somewhere. And if it's not coming from the foreign sector, it must come from the private sector. So you can change around these numbers, and we'll do that a little bit in the presentation, but this is the fundamental impact of this analysis, is that if the public sector balance, if the government's in surplus, that surplus has to be someone else's deficit. And if the foreign sector is a balance, then it must come from the private sector. So this is a bit more where we are when we look at the numbers for Scotland stroke the UK over the last 10, 15 years. So what we'll find is that the foreign sector balance is around 8% of GDP. We hope that the private sector net saves, okay, and I've got 2% of GDP. So every country and effectively hopes that its private sector can net save. It's not good if your private sector for a sequence of years starts spending all of its savings. We kind of want people to save so they feel much more financially secure. So let's say it lasts 10, 15 years in Scotland or in the UK, we've had a foreign sector surplus. Now that means that we're receiving more stuff than we're sending. So the foreign sector is in surplus with us. Our private sector balance, we want to be in surplus at 2%. That'd be 10% of GDP. Now, sectorial balances say, well, that 10% positive number must come from the third sector. The only other part of the economy has to have a minus 10. And that minus 10 is the public sector balance or the government deficit. Okay, so if you want there to be a positive or a negative, there has to be a negative somewhere in the system. So this about summarizes Scotland, UK, last 10, 15 years, in a very general sense to give you a flavour. So that's where the public sector deficit's going. It's going to a little bit to our private sector and then a lot to the foreign sector. Now, the really important point here is to say this is not economic opinion. This is an accounting identity. This has to be true. Now, you can certainly look at some of the numbers and say, well, maybe this should be here, or I'm not too sure about that one, or isn't it a little bit more here? But fundamentally, if you have a closed economy in the sense that these financial transactions have to go somewhere, they're either private sector, government sector, or foreign sector, this is fundamentally the relationship in our economy. So you can see the public sector deficit is going somewhere. A lot of it's going abroad, and some of it's coming to the private sector. So this is, I suppose, initially the most fundamental outcome from using sectorial balances, is you start to see that, let's say foreign sector's at zero, a government surplus by definition is your deficit, and a government deficit is by definition your surplus. So that's the fundamental insight. As soon as we start using sectorial balances, we start seeing the other side of the government's balance sheet. And I would suggest that people would be much happier with the idea of a government deficit and would understand why the government needs a deficit if we all used and understood the sectorial balances framework. So that's how fundamentally important it is at a kind of, no matter where you are, which country you are. This is why I think the sectorial balances is really, really useful. So drop me any thoughts on that. It's like the first third of the presentation. I'm going to get a little bit more detailed here before we go into Scotland's sectorial balances to give you a flavour. This is probably the most famous sectorial balance, and this is the St. Louis Fed, which releases America's sectorial balances. So people do use this framework. Now, this shows you, and I'm just going to quickly move myself off the screen so you can see it a little bit bigger, and then I'll bring myself back. Okay, so the green bit at the bottom is the American government deficit. And as you'll see, it's almost always negative. The government is almost always in deficit right at the start. And I really like this. This is why I often show this chart. Right at the start of this, you can see that there's no government deficit. There's no green below the line. And you can just, if you zoom in, you'll see there's a tiny bit of green above the line. But look what happens after 5 or 6 years of that in America. That's the crash in the early 2000s. And people would say, well, what would you expect if the government stops adding to the net wealth of the American private sector? Then you're going to get a recession. And this is how useful it is. And you can see, if you go further back in history and you do the sectorial balances in the States, you'll see that this relationship's quite strong. Now, you've got above it, and the Fed breaks it into 4 different sections, but it's a little bit too much detail. But basically, the blue that you see is the private sector wealth in America. And you can see that most years, it's like 4 or 5% positive. Now, this is exactly what you want if you're an economy. Now, the big problem with Trump is he's concentrating on this purple bit, which isn't even really that big. And he's thinking they're stealing our money, but they're not stealing your money. He has to concentrate on the private wealth of Americans, not what the government's spending or what the private sector. As long as that's a fairly big and positive blue part above, there's no problem for the American economy when it comes to this one lens about financial transactions. So really well known, used a lot in policy discussions in America in a way that is not in Europe. Although the European Central Bank did use this after the kind of bond liquidity crisis in 2010 up to 2012. So they have used this framework. Now, what we've got here, another example, here's Germany's sectorial balances. So you can see they're actually a different color. So I'll just make that clear. The red is the government spending, and you can see it moves from a bit of a deficit to a bit of a surplus. So mostly it's under the central line. So it's normally, certainly for the last 10 years or so, it's a government running a deficit. And this isn't the biggest or one of the biggest exporters on the planet. The government still runs a deficit. And that is because it wants the private sector to save, to net save. In this model, the black is the private sector. So you can see, if you live in Germany, you can see how much the government concentrates on the private sector being able to net save. It's really important for Germans and for the German economy that they're able to net save. Now, they're only able to net save the bit above the line because below the line, you'll see the foreign sector deficit. So because they receive so much money from abroad, that's what allows the government to have a small deficit, and it allows the private sector to save. So I hope you can already start to see how useful this is, even if you're just comparing countries from one period to another, or one country compared to another country. So there's Germany. I'll flick back to America. Okay, you can see a country that runs big deficits. Big foreign sector deficits. A country that has big foreign sector deficits here, foreign sector surpluses here. You can see there's that direct relationship. Now I'm going to show you the United Kingdom next. And here's the United Kingdom sectorial balances. And again, black is the private sector savings. So you can just look at this. I think it's the same or very similar timeline, but you can just see how small the black parts are in the United Kingdom sectorial balances. And I want you to think of them as the private sector savings. And everyone knows you're only really able to save once you've been able to meet all of your other needs and you effectively have spare cash. So look how often the private sector has spare cash in the United Kingdom. Okay, that's the black bits above the line. I'm going to flick back to Germany. Look at Germany and look at its black bits above the line. Now, the black bits don't come from the government. They come because the country runs a trade surplus. But in the UK, if we want big bits of black and we run a trade deficit, that has to come from the government. And it's not coming from the government. So that's why we have so little net financial wealth in the United Kingdom. Now, what sectorial balances don't do, and this is really important for us to understand for a complete picture of the economy, it doesn't say who within the private sector has all of this wealth, but it does tell you where that wealth is going. Is it going to the private sector? Is it going abroad? Is it coming from the government? So I think that's absolutely fascinating when you look at the differences between those countries, and we got to focus on that black part and not on the red part, and not necessarily on the blue part when you create your own currency, because it's not a problem. You know, there's not a problem. These are completely sustainable if that red bit's bigger to make the black bit bigger, or the blue bit smaller to make the black bit bigger. But what we find is that all we really want to do is shrink that red bit, and it doesn't increase the black bit, which is private savings. And that's what sectorial balances get you to focus on, increasing the net financial wealth of the private sector, which is me and you. Okay, so are you ready for Scotland's sectorial balances? So quite a lot of effort went into this. It took us almost a year. Now, this is using a lot of the figures from GERS, but also from other Scottish government publications. And this is where we are. Now, the colours are different, but I'll very quickly talk you through this. So we have the green, which is the foreign sector surplus. The foreign sector takes more financial wealth out of Scotland than it sends back. The blue is our net savings position, and the red is the public sector or the government spending. So I think you've got to look at this for what it is, and you'll see that a big issue we have in Scotland is that the money that comes from the deficit spending, which comes from the UK government, and it's the UK government that deficit spends because the Scottish government isn't able to deficit spend in either local authorities to any great extent. The deficit spending comes from the United Kingdom, but it rarely allows the private sector in Scotland to net save. So that money that we are supposed to be taking from the government as some kind of handout is not remaining in the Scottish private sector. It's not remaining with me and you. It's disappearing abroad. Now, a really interesting subplot to this is that that green part includes the rest of the United Kingdom. So we plan to work out how much of that green bit is the United Kingdom, because what would be really interesting is to see how much of the deficit spending that comes from Westminster ends up back in the rest of the United Kingdom. So there's some kind of loop there that no one's really investigated. But these are the types of things you can start to analyse when you have this framework. So you'll see that the public deficit, the money that's spent in Scotland, isn't enough to allow us to net save. You'll see, I think it's only 5 or 6 years. Well, it's 8 in total, including COVID, but it's only 8 years out of 25 when we were able to net save. And I guarantee you the vast majority of that private net wealth that's saved will be within the financial services sector and not people like me and Kieran and everyone who's watching. So it's absolutely fascinating when you look at that. Now, I'm just going to take a break here because I think it's really important. Thanks very much, Ben, for commenting here. It's really important to make it clear why everything has to sum to zero. Okay, now it's what's called an accounting identity. It has to be true for it to be called an accounting identity. And what it just means is every single financial transaction that takes place in Scotland, there must be two sides to that transaction. If someone buys something, spends money, someone earns money, and they can save that or they can spend it somewhere else. And when you look at a national economy, there's only 3 sectors that we use for sectorial balances. You saw in America, they kind of separated one of the sectors into 4, but for every financial transaction, it's either made by the government, the private sector, or the foreign sector. There can't be anyone else. So all these transactions must sum to zero. That's why they're called balances, because they must balance. And what you'll see here is everything that's on the above the line is reflected by everything which is below the line. So that's why we can look at this and say it has to sum to zero, because it's a complete account of every financial transaction in a country. Okay, any other questions and comments as I go through, please do add them. So that's Scotland's sectorial balances. Now, what I'm going to do now is I'm going to look at in a little bit more detail for Scotland, those 3 sectors. Now, what we did in the paper, we increased the amount of GDP growth that Scotland was likely to experience for our main scenario. And we just said a high rate, taking things forward now with a 1.4% GDP growth, which also meant 1.4% increase in consumption, in exports and imports, in savings. What would the sectorial balance out level at? And what we found was we'll have roundabout a 12% government deficit, a private sector net financial savings around 5%, and a foreign sector surplus at around 7%. Now, that's what we found when we used that growth rate, and we just pushed everything forward. It's a fairly simple, macroeconomic model, but this is what we used, and we found that this is likely what would happen. Now, the really important point to make here is that's absolutely fine. It's completely sustainable for an independent Scotland, in the same way it's completely sustainable for Scotland as part of the United Kingdom. A 12% government deficit, 5% every year increases our net financial wealth, and 7% foreign sector surplus. Completely sustainable. No one should be complaining about this. This should be our default position for moving into independence. Now, this goes completely against the suggestion by the Scottish Government to align with the EU Stability and Growth Pact, which was right at the heart of our paper. So looking at the 3 sectors to explain a little bit more detail what's happening in Scotland, let's look at the foreign sector first. So this is basically imports and exports. I want to concentrate on the yellow line at the bottom because that's the difference. So what you'll see is roundabout from 2013, Scotland moved from a slight exporter to a slight importer. The big spike in 22 is around oil. So still fairly dependent on big spikes on oil and gas. And obviously that's reducing and will reduce substantially, especially with the closure of Grangemouth. But you'll see that Scotland has roundabout a kind of, let's say, maybe a 5 to 10, maybe that's a bit much, maybe 3 to 5 billion pound trade deficit every year. Okay, so you'll see that. So this is just trade. This is the financial transactions related to goods and services coming in to the country. Now, if you add that, and you have to do that for the sectorial balances, you have to add all the other financial flows. And again, you could look at the yellow line. Now, this is a significant difference between Scotland and a lot of the other sectorial balances that you'll see. But Scotland's net outflow of financial assets is round about 11.5 billion every year. 11.5 billion every year leaves the Scottish private sector and is financial assets owned abroad. Now, what we found is that, and this is a direct quote from the paper, between 1988 and 2001, Scotland had an average net income flow of approximately minus 11.5 billion, and this is around 6% of GDP. Now, the largest part is returns on direct investment as investors extract their financial gains. If Scotland becomes a hub for FDI, initial inflows will likely be accompanied by later significant outflows. That's the whole point of investing in a country, is to take more out than you put in. Now, this surplus in the external sector, which is where we are now, this implies a deficit in either the government sector or the private sector. Do you remember when we looked at those numbers and how they all have to add up? So if we've got a 6% just in net financial flows, add 1 or 2% to that in our trade deficit, you've got 8% of GDP as a plus. That negative has to come from somewhere. But this is a position we can show with the sectorial balances in Scotland when we look at the foreign sector. And you'll see again, the foreign sector surplus shows up in that green part above. And in most cases, the reverse is the private sector deficit and the government deficit to balance that. Because remember, all those financial transactions have to come from somewhere and they have to balance. Now, the next one is the domestic private sector. That's the me and you balance. Okay, now this, as I said, this is where we are when we project forward Scotland's sectorial balances. And there's absolutely no problem with this, completely sustainable from a financial perspective because we're growing the private sector. And that's the most important thing for us to concentrate on. This is where we are. Now, I want you to keep your eye on the red figure here. Okay, so right now, the public sector balance, minus 12. And let's look at the private sector balance, plus 5. Now, what happens when we move towards the EU's Stability and Growth Pact? Well, the private sector balance, to keep within the Stability and Growth Pact, goes to minus 3. But where does that financial wealth come from? If the foreign sector balance is going to stay the same, which it invariably will, then that private sector balance moves to minus 4. So here we are, plus 5 GDP, where we are moving forward, everything's fine, to minus 4 GDP to keep or to move to the Stability and Growth Pact. Now, I think this is the fundamentally most important thing that comes from using sectorial balances to explain the Stability and Growth Pact, that minus 3 moving from minus 12 can only come from the private sector. That's me and you. And you'll see that. So just imagine that red goes all the way up to the bar. Then the only thing that's going to arise is the blue is going to shrink to replace it. So if that goes all the way up to 0, then that has to turn blue, and that's our net financial wealth that's being drained to get to this 3% figure. Now, that's probably a little bit shocking, but this is what we came up with, and it's the inevitable conclusion from that. Complying with the Stability and Growth Pact, which is the 3% public deficit to GDP, would collapse economic growth, raise unemployment, and reduce public goods and services. It would also likely increase household debt stress, disproportionately affecting the lowest earners, women, children, and minority groups. Now, for most people who support independence and are progressive, this should be truly shocking, but this is the outcome of the plan from the Scottish Government if you use our framework and our analysis. And you can look into this in a lot more detail in the 28 pages that we've got. So we come to that conclusion. We look at various ways. Now, that means austerity, clear-cut austerity. The only way you can do that is either to reduce government spending or increase taxation. And what all governments tend to do in this position is reduce government spending, because you can control that a lot more than you can trying to control the amount of tax that you take. Now, there's certainly a way that we could persuade the Scottish Government to take that approach to do for the tax, but there's nothing in the current prospectus that talks about increasing tax or going after wealth or any form of income generation from tax or revenue from tax in any of the publications. So we've just said we'll have to go down and suggest that they go down the normal route of other countries. And you can see here that the lowest average earners in Scotland are in a position where they can't deal with austerity. They can't deal with debt stress. This chart just shows you the 50% of the poorest people in our country in terms of income. And you'll see that income has barely risen in 15 years. Now, that included a period of austerity, and you can just see that kind of dip down there from 2010 to 2013. You can see that just coming down, and then it starts to get back up just as kind of fiscal austerity kind of ends, and you can just see it. But imagine if that contracts again on top of the 15 years where people's incomes have been really stagnant, which means they've got no financial or not much financial wealth to call on. But these are the people who are going to be hardest affected by this switch to our economy focusing on fiscal rule, which is the EU's Stability and Growth Pact. So really shocking when we think about the people that we know that the Scottish Government most wants to protect, is that those are the ones that are likely to be harmed the most if this kind of fiscal austerity took place. Now, I want to finish on this because this is, for me, completely backwards. And we have all of our governments focusing on the public balance, saying it should be 3% or it should be -3%, or, you know, we need to look at our spending to stop this. The public balance is the residual. The public balance reacts to the saving demands from the private sector and the foreign sector. And we see this in the paper, maybe not as clearly as this, but the public balance is just what it is. It's ex post. The public balance is what you've got at the end after everyone's made their saving and their spending decisions. And you'll see that when we look at the Scottish sectorial balances again, because the foreign sector extracts so much wealth and people tend to save, and we want them to save, the public balance, the public sector balance, is just the thing that fills in the gap. If it's plus 10 on the top line, that must be negative on the bottom. So the public balance is just the absolute worst thing to try and control, because it's the thing that reacts to the demands of the private and the foreign sector. It's crazy that we've selected this thing that's so hard for the government to control as the thing that it should be focusing all its effort on, because it just is what it is. So again, look at Scotland's historic public deficit. When you see it like this, a lot of people will think this is shocking, but this is just evidence that the money that comes into Scotland, a lot of it disappears and doesn't provide enough for Scotland's private sector to save. So there's a huge issue with the structure of the UK government right now, the UK economy right now. And I think this puts the clearest lens you can possibly have on GERS. And it shows there's a huge issue around GERS because there's a focus on this part and not on those tiny blue bars that we saw in Scotland's sectorial balances. The focus has got to be on reducing the debt stress of the private sector and allowing the private sector to have net financial wealth. So this public balance is just the thing at the end. And what we need to focus on, and this is a quote from Michael Kalecki, this is in our report. So people decry these public deficits. And Michael Kalecki said, opponents of such government spending say that the government will then have nothing to show for their money. The reply is that the counterpart of that spending will be the higher standard of living of the masses. Is that not the purpose of all economic activity? And this completely supports a sectorial balance view, because it shows you that government spending is designed, or supposed to be designed, to increase the net private wealth and net financial wealth in the private sector, and that's not happening. So to kind of summarize, sectorial balances show us at a macroeconomic level that aligning with the Stability and Growth Pact can only be done by shrinking the private sector, and that's austerity. It's absolute madness to think that we can move from a 12% government deficit to 3% government deficit any other way than crushing austerity. The longer period you take it over, the less the austerity. But if you want to do it in a decade or less, it's absolutely crushing, unquestionably unpolitical movement of our economy to go for that. And this is the evidence that we're taking to the Scottish Government. So the main conclusions. we need to highlight that a sustained double-figure government deficit would be manageable for a nation with monetary independence that followed policies to increase its economic resilience. It would not present an inflationary risk or downward pressure on a new currency. In fact, a private sector surplus would be essential for Scotland to chart a different economic path from the UK. Is that not the point of independence? So this is a message that we are taking as widely as we can to the public, but to the Scottish Government when we meet them next month. If you understand sectorial balances, you understand deficits, and you understand that that is how you create net financial wealth, and that's what we want from independence. So this is why I think they're so important. Now, we're going to take at the bottom, I'll show you, the Scottish Government should collect and publish Scotland's sectorial balances, and that's what we hope to persuade them to do next month. And we think if we do that, it can really start to change the whole conversation in Scotland around government deficits. And my final point here, this is one of the most important lines taken from A Stronger Economy with Independence, the Scottish Government's paper in 2022. And for me, this highlights the deep contradictions within that paper. And it says that independence will allow us to tailor policy to Scotland's needs, build greater equality and well-being, and become more resilient. And what I would say was, and Dirk was in agreement with the paper, this is exactly what independence can deliver. But aligning with the Stability and Growth Pact is not tailoring policy. It's copying the policy from a bloc with 27 countries that you're not even a member of, which was designed for a particular economic and political reasons. So indeed, tailor the policy. And when you do that, there'll be no following the Stability and Growth Pact. And we believe that if we use the sectorial balances as a tool, that'll help us do that.